Hi all, welcome to another edition of Nucleus Investment Insights. We wanted to dig in today and talk about the gold boom, whether it's turning to a bust, are there any sort of cracks appearing in the in that. But I thought actually what I'd do is have a bit of a deeper run through gold overall, and really sort of talk about gold as an investment class. What does it mean? Is it something which we can where does it sit within your portfolio? How do we sort of think about it, and what are the main drivers in terms of sort of as a longer term investment? And then how do you play that? Do you buy the stocks? Do you buy the gold? Do you hedge it? Do you not hedge it? All those thoughts should be going into what you're trying to do within this. So just a reminder that everything you hear today is general advice in nature. None of it's personal advice. If you do want some personal advice, you can follow the show notes and have a talk to somebody. And with no further ado, let's sort of jump into this idea that we're on this golden rocket at the moment. We've seen the gold price sort of from over the last few months go sort of the 2000s and 3000s into up into the 4000s, and it's sort of hit this real exponential stage. And it's I think that's a point. We've had a couple of quite volatile days within gold. So the idea that the big reversals and then back up the other way, and nothing. And I guess there's two parts to this. Nothing ever moves in a straight line, but also I think gold in particular can be volatile around changing points, and it's been on such a tear recently that some sort of pullback is as a traders would say, healthy in terms of the longer term exposure to it. So okay, so that's the sort of where the gold price is at. Question is, who's actually out buying it, and why do you buy gold? So I'll jump into a bunch of the different reasons for wanting to own it, but I think there's I thought I'd start with one of the demand. So there's a US one from the World Gold Council talking about demand for gold coins. Demand for gold in terms of tons and how that moves over time. And we can sort of see that we've got these this positive and negative on this chart that we're showing, and the key one is these big dark blue lines you can see, which are really sort of driving. That's where the real difference is. Most of the others are pretty consistent from time to time, from period to period, and what that line is that is exchange traded funds. So I've titled this slide the greater fool, but and the sort of the reason why people talk about gold being this greater fool investment is most of the reason you want to buy gold is because you think you can sell it to somebody else at a higher price, and the level you can see in terms of how much gold demand is coming from ETFs, and then if we add in central banks as well on top of that, is just way above any other source. So the demand for jewelry, for example, is there, and it's there every period, and it's pretty consistent, and it really doesn't change that much from time to time. You get a little bit of seasonality, some of that sort of driven particularly in India, but around certain holidays and things like that. But realistically, what we're looking at is the key sort of swing factor within this is really what are investors doing, because your increases in your gold demand really aren't going to make much of a difference to what's happening there. There is some technological demands as well, but again, that's a pretty small bar within that. And then bars and coins tends to be very much on the investment side as well. So you can sort of add those into that, and that sort of gives you that feel for what's happening in terms of the production there. And so the question is, why do you want to own gold? And there's a bunch of reasons we'd sort of posit as to why people do. The biggest one is that it's a bit of an anti-US dollar. So it acts as a currency sort of in its own right. And so as you're buying gold, there's this thought behind, when the US dollar is weak, that tends to make gold strong. And some of this is literally just mechanical insofar as the US dollar is sort of the most, is the most widely traded currency. It's what gold tends to be priced in. And whereas the US doesn't make up anywhere near the amount of gold purchasing that it does in terms of its in terms of its weight. So in a way, if you thought about gold as being this sort of globally owned asset that just happens to be priced in US dollars, well, when the US dollar is falling, well, the gold price in US dollars will be rising. And so there is that sort of one of those. That's one of the key parts behind this, is saying, well, if you look at a global perspective, and particularly that gold, will get bought by some more emerging markets, places like India that have quite a strong history of owning a lot of gold, is that part of what you're seeing is really just this anti-US dollar exposure, and so maybe it's maybe a better way to think of it as it's just a translation of this global asset into one particular currency. And so that's where, and I will get into this a little bit later on, but there's this idea when you are buying gold, particularly in Australia, about saying, well, do you want to hedge it? Do you want it unhedged? What is the reason you're buying it within that? And understanding that because it's priced in US dollars, that doesn't necessarily mean that's the only implicator that's on it. And so that's So the first thing we're doing, you might want to buy gold, is really this idea that US dollar is going to be weak. I want something else that's not going to be weak while the US dollar is weak, and so gold is one of those assets that makes sense. As an inflationary hedge is quite a common thought for people in terms of why else you would buy gold, and I put a maybe behind that because it is an inflation hedge, but it might not be as great as you might think. So there's, I think a lot of the history comes from this. I've just got this gold chart back up, from the 70s, and talking about how we had a lot of inflation in the 70s, and gold was this great inflationary hedge for you. Particularly in the late 70s, where the gold price really ran up significantly over that time frame. But the 80s had a lot of inflation in the 80s as well, and you could have bought gold, in 1980 and lost 50% of your quite quickly within a few years, and really over that next period, 80s and into the 90s, inflation was certainly it was decreasing, but we had a lot of inflation, and gold really didn't protect you over that time frame. So there's certainly what I would call an expectation that gold is going to protect you from inflation, and you will see over a short period, when you get higher inflationary reports than what people are expecting, that tends to be a good thing for gold. But I think the history of gold protecting you from inflation is a little bit more mixed. It all really depends upon your starting point and when you wanted to choose, when you chose to sort of to draw these lines. So that's sort of the second reason for owning gold as an inflationary hedge. Third reason a lot have is the idea that it's a safety trade and the geopolitics. So when people are concerned, when we see volatile markets, volatile geopolitics, then people go for something that they perceive as safe. And gold has been sort of fulfilling that role for thousands of years in terms of that perspective. And so from that idea, the idea is, do I hold gold because I think that Trump, for example, is shaking up the entire world order on geopolitics, and so therefore I want something that's going to give me a bit of safety behind this. And so that's that's your next reason. There's this, I think, from if you took an extreme view, or certainly maybe you just want to hedge some of the tail risks. So gold does act for the fourth reason as an insurance hedge on societal breakdown. And so what do I mean by that? Well, if you are particularly worried that you're in a country that's going into societal breakdown, or you've got bigger concerns about whether it be I don't know. I don't want to seem like a conspiracy theorist, but if you took into extreme weather events that cause breakdown, or sunspots are wiping out electricity networks and affecting or hacking that blows up banks or whatever it is. If you took views that, look, I want something in case everything goes wrong, then gold fulfills that role, certainly as a war breaking out and things like that. Gold can fulfill that role of saying, okay, when I can't access my bank and my credit card won't work and things like that, is there something I can exchange for food and guns and money and whatever it is that you're going to need at that point. And certainly gold plays a role in that. And then having said that, though, if that's your reason, you're looking for an insurance hedge on societal breakdown, the important point is your gold ETF is probably not going to help you at that point. And owning a gold bar is not either, because you might have a gold bar, but taking that down to your local shop to barter for food or whatever like that, they may not have the change, and it might attract more attention than you might want. So yes, so insurance hedge. So spoke about it being an anti-US dollar, an inflationary hedge, a safety trade, an insurance hedge on sort of some broader societal breakdown. And then we move into these ideas we spoke about before. For the fifth reason is this idea that other investors want it, and otherwise known as the greater fool. But it's basically, I'm buying this because I think other people are going to want to buy it, and then I'm going to sell it back to them at a higher price. And so that's the and that's from an investor's point of view. There's another one as well on the same basis of central banks in terms of saying, I'm buying this because I think central banks are going to want to buy this. And because central banks are going to want to buy it, I want to get basically before they do, and then sell it back to them. Now that's got a bit of legs behind behind that as an investment thesis. So I've got a chart up just from Visual Capitalist, just showing that central bank holdings of US Treasuries is now back below central bank holdings of gold. So central banks, that fell from, 50%-ish, somewhere between 40 and 60% sort of back in the 70s and 80s. And a lot of that fall we saw right throughout the 80s was central banks basically deciding that they didn't need to hold gold anymore. So, the world had come off the gold standard, and the idea of central banks basically digging up a bunch of gold and then burying it in their own underground in their own vault meant that there was that was sort of no longer needed, and so you'd be better off with other instruments, and US Treasury sort of took over as one of those things. In recent times, we saw Ukraine war break out, and we saw the Russian reserves in particular seized, and what that's meant is a sudden desire now for central banks to be a lot less dependent upon US Treasuries in case they sort of run into that same problem, and the realization that, look, you can have your assets seized if you're a country doing things that other countries might not approve of. And so that sort of there was an initial part of demand from that, and then we've had this sort of secondary leg of demand as Trump's got into power, and I guess the level at which he's willing to break up prior norms. I think there's Brazil is a pretty good example of this. I'll take one step back. For a lot of countries, the idea that, look, my US Treasuries might not be safe if I'm a country that doesn't have sort of deep ties to the US and is a more marginal player, and so it might be somebody you might be whatever, Bangladesh or India or whatever country, Cambodia, and you're not sort of within the US's close-knit circle of friends. You might decide to do something with one of your neighbors in terms of that you think is right, and you don't want to have to worry about the US seizing all your assets because they decided that that you weren't right, and they sided with your neighbor instead. And so that was sort of coming out of the Russia-Ukraine. I think there was a lot of countries that sort of made that decision of saying, well, let's start diversifying away from US Treasuries and let's start buying more gold. Then I think there's another round in terms of people who were relatively friendly, countries that were relatively friendly with the US, and really didn't have any sort of concerns over that first round. And I'm picking out a country like Brazil, where you went, well, we've got this huge, we import all this stuff from the US. We've got this huge trade deficit, so the US should be pretty happy. You've got lots of exports and imports coming through, democracy, relatively close relationships and things like that. And then the next thing you know, Trump's sort of whacking 50% tariffs on Brazil because it doesn't like what it was doing to a friend of his who of a similar political leaning. And so all of a sudden, countries like Brazil, who probably wouldn't have been worried about doing something that the US would then feel like it needed to expropriate its assets for under normal circumstances, suddenly starts to think, well, maybe we need to spread our reserve assets around a little bit more. And so I think that's sort of been behind this whole central bank reserves as well within that. Okay, so we're up to number. We actually might jump quickly to a quick sales message, and then I'll come back with the next reason to hold gold.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right, so coming back to our final reason for holding gold is more of a view that there's some sort of reason to go back to an historical case where gold gets treated as pegged to the US dollar or whatever it is. You go back to some sort of gold standard. Now, ordinarily you'd say that would seem unlikely to happen, but I think Trump last time was certainly trying to put a gold nutter onto the Fed. There hasn't really been any movement on that direction at the moment, but I think I'd be hesitant to rule it out. So there's sort of like this idea that, and I think there's certainly from a gold bugs point of view, or the people who are very focused on gold as touting its positives, is that there's this idea that at some point society will have to go back to this part where gold forms gold is money. It's tangible. You can feel it. Whatever the reasons. They've got lots of different reasons for it. Not completely on board with a lot of them, but there is that potential at some point we decide to readopt some sort of gold standard. So so we've got 7 different sort of reasons for this. Now, you don't have to believe in all of them, and in a lot of cases, some people who believe in some of these don't believe in the other ones. But if you're buying it for if you think it's an inflationary hedge, and it may not be an inflationary hedge, but if there's a society, a part of people who are out there buying it for an inflationary hedge, and then there's other people out there buying it because they're worried about a weak US dollar, and there's other people worried about it buying it because they're concerned about geopolitics and the whole breakdown. There's people worried about the entire breakdown of society in World War III or whatever it is, and you're going to need that gold. There's a bunch of people out there who are buying it because they think other investors are going to be buying it, so they're trying to get in front of them. There's a bunch of people buying it because they think central banks are out there, and they're trying to get in front of central banks. And then there's other people that are buying there because they think at some point we're going back to a gold standard. And that all these factors seem to be moving in the same direction at the moment, which is why we've got that sort of rise in, or why we've seen this sort of exponential rise in the gold price. So, so I've got all these factors all sort of working together to sort of push it up at the same time. And then the question is, well, how high can it go? And this is the real issue, I think, with gold, is that it's sort of untethered to anything. And it's the issue, similar with Bitcoin or whatever it is what is this worth? Well, it's worth whatever somebody's prepared to pay for it. I think the gold side, from the gold side, there is an element of how much can we dig up out of the ground, and how much can we how much can companies genuinely dig out of the ground and supply this demand? Or, potentially at some point, we spoke about, I can't remember, I can't point you to exactly the edition. I'll try and get it into the show notes later, but we had a space engineer on, and we spoke about the economics of sort of moving asteroids and stuff like that, because there are, massive amounts of gold in some asteroids. And so, if you get to a certain point and you think that actually what humankind really should be doing with all its resources is, rather than trying to solve climate change or other issues, we should be trying to, grab an asteroid full of gold and drag it back and work out how to get it safely back down to Earth so that we can all have lots of gold. If that ends up being if that was our primary, one of the primary goals of the human race, it's probably relatively possible right now. Very, very expensive, but the cost over time is going down, and robots and costs to get things into space is reducing. And so, there's other things that might happen in terms of increasing the gold supply. But, in the immediate short-term future, gold is actually pretty hard to get out of the ground. There aren't very large supplies of it. And so that idea that, the gold supply catching up is going to take a considerable period of time for the gold supply to catch up. So, so that's... So let's have a quick look at some of the other sort of interesting things around gold in terms of the production, because it is very different to other metals. So I've got a gold cost curve up, and so what this is showing is this is all the mines. So down the bottom is the production, so how much production gets done in a year. And then that's on the x-axis, and then on the y-axis is how much that's cost in terms of the total cash cost. And so the idea behind this is that we've got the cheapest gold mines on the right that are on the left that are producing at sort of $500 ish per troy ounce. And then as you sort of go up, that rises to over 1,000, and the more expensive gold mines are all on the right. Now, this is a very different chart to what you'd see in pretty much any other mineral. Any other primary mineral that's probably a better way to say that. So what do I mean by that? So when you're mining, there's really only a couple of different ways, a couple of different sort of broad senses in terms of the way people mine. So I'll use iron ore as a good example. People are looking for iron ore, they find it, they dig it up. They tend to find that they tend to find that scale is really important. So you can get these top tier mines that can produce 10-20% of global demand, and you look at the top sort of top 10 mines, and they might be producing 50% of global demand or something like that. And so it's really about economies of scale, getting these massive mines that you can really get your costs right down. And then you sort of get the smaller mines, and they'll have higher costs, and they'll sort of drift in and drift out. And so say in the iron ore bit, there might be, the big guys, the BHPs and Rios are all producing at $50 a ton. The small guys might be, there's sort of $80 or $100 a ton for those small ones. And, when the price falls from 100 down to 80, those small ones, shut up shop and then might come back, if the price rises again. But they're in and out, but they make up a pretty small amount of the market, and they're sort of that right-hand side of the cost curve. Okay, so that's a more typical mineral, and similar within things like copper, lithium, whatever, all these sort of primary minerals where people have got they've got a mine, and that's what they're digging out of this mine. There are some minerals where it's a byproduct, and so what it means is that some of the key uses, some of the key ways that the mineral gets produced is people are out mining copper, and they actually also get some other mineral included, and so they'll take that and mine that. But the driver behind the demand tends to be that primary, the copper one that's produced. Anyway, so where am I getting back to on gold? Let's get back to that. the key thing with gold is, as you can see from here, the vast majority of this cost curve is well under $2,000. And so these guys are all making lots of money at the moment, but they actually don't have that much leverage. So, and what do I mean by that? Well, let's say you've got the gold mine that's producing at $500 a ton. When gold was $500 per ounce. When gold was $2,000, you were making $1,500. When gold rose to $3,000, now it went to $2,500. When it went from that up to $4,000, we're now making $3,500. So it's great. I've increased it, but I've sort of only, from the $2,000 upwards, I've sort of a little bit more than doubled my profit. Whereas if I'm producing at $2,000, okay, now when the gold price goes to 2,100, well, at 2,000 I'm making no money. When it's at 2,100, now I'm making $100 an ounce. When it goes to 4,000, I've gone from $100 an ounce to $2,000 an ounce. I'm making way more money. And so you've got lots of leverage to that upside. Now, that tends not to happen across most of these existing gold miners. So they're out producing every sort of extra dollar you get on terms of the gold price at the moment really doesn't make that much difference to their profits. Okay, so that's one part. They don't have as much leverage because the price is so high. Second part then is, okay, is there all this extra demand that's going to come on? And the difference with gold is, look, there really aren't that many massive, well, not aren't that many. There aren't any massive gold mines that are sort of sitting there waiting to be turned on. So looking, say you're talking about iron ore again. There's a huge iron ore mine in production in Africa at the moment as Rio sort of builds that up. And that's going to make a meaningful dent in terms of world supply. You just don't have those sort of sitting around in the gold market. And gold tends to be actually dominated by lots and lots of really small mines. And one of the things with a lot of these mines is you're digging up quite small amounts of gold per ton. So you might be talking about a gram per ton. And a good gold mine might have 5 or 6 grams per ton or 10 grams per ton or more. And so those ones are actually, 10 times more profitable than that's one that's only got 1 gram per ton. And there's places that, very deep in South Africa, they tend to be, where it makes sense for literally people with jackhammers to be sitting, 1,000 feet under the earth, jackhammering away at these gold veins because they have so much gold within them. And so, and it's not an industrial production. What happens when I want to expand it? Well, I hire a few more guys and I buy a few more jackhammers. They're quite narrow veins that are just really, really rich, and so they're just worth doing this on on basically by hand still, versus the industrial scale mines we see elsewhere where it's all about automated machinery and just these massive amounts of earth being moved. Gold just tends not to be like that. You've got a few operations, and there's some, some of those sitting within Australia that sort of have these mass mining techniques. But, in terms of the expansion now, it's actually not going to see that much. There's no obvious place you can go see that the expansion. Lots of small, no massive big ones. That's sort of going to make that massive difference to it. Okay, so that's that gold price. Next thing that is worth knowing, okay, well, what is that in terms of, say, Australia? Is there some massive boom coming for Australia on the back of this? And so if I look, I've got this chart up from Macrobond and CBA, just sort of looking at the top Australian exports. And so you can see throughout 2025 that the gold has shot up to, looks like it's closing in on natural gas, coal, iron ore in terms of the levels. I do want to highlight though, this is a log graph. And so it's not as, it's actually nowhere near as close as what it might look like on that. But, a lot of that was priced at, sub $3,000. So, if gold price is 4.5, you're probably going to be closing in on, you probably will see gold sort of shoot above, say, coal and gas, and might even threaten iron ore as being the largest export for Australia. Having said that, it's not Australia's not that big in terms of gold globally. Like, yes, we have a lot, but we're not. It's not like we're the top producer, whereas we are in iron ore, coal, and natural gas. We're one of the top producers out there. sort of well above everyone else, whereas gold would be one of the top 10, but we're not sort of by far and away greater than other countries. So that was one part on the effects in Australia. So the next part then is saying, well, if there's this massive capex boom, and people are going to be building gold mines everywhere, Australia does have a lot of potential for new gold mines. What does that mean in terms of Australia? So I've got a few ones up just sort of showing the expectation for gold production within Australia, and you can see there's quite a difference in the value produced versus the amount. Now, the issue we have though is that if I look at gold exploration, there's 400 million in the June quarter, which was significantly above some of the prior ones. We've had some massive growth in recent months. So if let's say you annualize that sort of gives you 1,600 or 1.6 billion a year spent on gold exploration. That's about 0.1 of Australia's GDP. So even if you tripled the level of gold exploration from where we are today, you're just not moving the needle much in terms of GDP. So yes, be big for the individual providers, be big for people who are service providers to that industry. Big in a whole bunch of ways, but really in terms of is it going to move the needle for the Australian economy? No, not in the same way that we saw the iron ore boom or in particular the gas boom, where one project in the Gorgon project was sort of $50 billion, and we're talking about 1.6 billion spent in gold exploration. If you annualize the most recent one, and if we're talking doubling and tripling that, and you're going to sort of 5 billion, say, of capital expenditure, it's just not even in the ballpark of one major project, one major gas project. So yeah, a positive, but just not at the same level as what we saw elsewhere. So yeah, so big picture wise, in terms of gold, the producers themselves, it's about saying, well, yes, they'll make money from this. The producers will see profits, significantly higher profits this year than what they saw last year, but the profits are not going to be growing as fast as what they have in the prior one, just because your costs are so much lower now. So yeah, when it was moving from 2,000 to 2,500, there was a big increase in profits. From 2,500 to 3,000, still a significant increase in profits. Yes, this last rise from 4,000 to 4.5, just not the same magnitude of profits that you're going to see, profit increase you're going to see from the producers. Still good for them, but just not the same percentage increase. So so that's sort of the broad part. So let's go to a quick sales message, and then I want to talk about the investment side and what can you invest in, what are your options, where's the most, what are you going to see coming out of this?
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now, direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Right, I might first go to some questions actually, because there's a bunch that are popping up. There's obviously an interesting topic for a lot of people. So one of the questions from Leo, just questions about the years where the gold didn't move much during the 80s and 90s. Was there much money printing during those years? I think the biggest factor for those was central banks selling back their holdings. So no, we didn't have as much money printing. But there was significant inflation. So still had significant deficits. Inflation during the 80s was way higher than what it was during most of the 2000s. And so, Yeah, so you did have this idea that the gold price through the 80s did not move and didn't protect you from inflation, but primarily driven by that central banks deciding actually we didn't need to hold all that as much gold as what they used to and selling that back. And so that's what I was saying about this idea from behind gold is, your two big factors is what are central banks doing, what are other investors doing, because that's going to drive most of it. And so if central banks are moving in one direction or the other, you don't want to be on the other side of that. And then investors, will often try to pick what central banks are doing. And at the moment, central banks are still loading up on it. And so it's very hard to say, well, what's going to tether them to anything realistic? So some other thoughts from Regis. So the question is, this idea of purchasing power, and that if you're looking at gold and looking at assets priced in other gold, the one is used in particular is housing prices. Housing prices really haven't moved much if you look at them measured in gold over the last few years, and that's certainly true. The question is, is that your primary measure? And so some people will say, yes, this is what I need. Everything should be based on gold, and our whole monetary system should be based on gold. I think I won't go into those arguments. It's a much longer argument behind that. I don't think we look close to going back to that environment. And so for me, it's more about saying, well, if people are out there working and earning money in a currency, and then what are they spending that on? That's the sort of key part that we need to be focused in on. What does a unit of work translate to in terms of buying a house or buying groceries or buying whatever it is that you want to buy? To me, that's a much more important factor of somebody, a worker doing work, getting paid for it. That's what we should be focused on. But I acknowledge that there's other people who have different views and say that gold is the only true measure, and so maybe that's I'll leave that at that. Is there a question about? He's also making the point that we might not be going back to the gold standard, but will the US government start treating gold differently and revaluing mark-to-market gold and things like that? And I think there's certainly I think Trump has shown a willingness to change things. He certainly spoke about in the past having somebody who was very much a gold bug as part of the US Treasury. None of his current ones are that way inclined, but as far as I can tell. But would I put it beyond that we could all of a sudden be in a regime where Trump's decided that gold is a new asset? No, I don't think that's I think that's entirely possible, and so it's certainly a risk factor that people should be aware of. Okay, so that was sort of the main questions, I think. And then one of them, is coming back though to the to gold exposure. How do you get a gold exposure? Stocks versus gold itself. What does it actually mean in terms of that? And so within our main holdings, within our direct indexes and our tilts. So just to put it back, if you didn't really listen to the ads we had, Nucleus runs these core portfolios where we've got all these assets, and then around those core portfolios you can add things around. You can add in more of things or less of things. And so we have 4 different tilts that people most commonly use. A physical gold tilt, so where you get the spot access to spot gold in US dollars. An Aussie dollar physical hedged physical gold, where it's the spot gold price with an Aussie dollar hedge on top of that. What I'd call the mega cap gold stocks, which is your sort of $20 billion plus global producers. And so these are the stocks where you're really getting this diversified portfolio. They're probably in multiple countries. They've definitely got more than one major mine, stronger balance sheet, lots of scale. There's broad exposure. You're not really exposed to, say, production problems at one particular mine all of a sudden causing major issues. So yes, they can have production problems at major mines, but that mine might be 20% or 30% of their overall production, and so it's not going to destroy the company or not going to risk the company. Whereas the mid-cap gold stocks, that's sort of the next phase down. We've got these dozen or so global producers, and they tend to have a couple of major mines. They're sort of more your $5 billion to $10 billion mine. You can these are the ones that are much more likely to be taken over. I think if there's if we go into over the next sort of 6 or 12 months, what you typically see in these is when you get the gold price rally, the large guys who've got some capital and now they've got some pricing power and their share prices get pushed up because everyone's wanting to buy them, is they start going, well, what are we going to do with this money? We can go and build a new mine, but gee, that's going to take a long time to come on. If we really want extra gold, why don't we just go buy a few things? They tend not to buy the really small gold mines. They tend to look to try and buy some of these mid-cap ones where they go, yeah, okay, I can spend because the bigger ones might be $50 billion in size. Going out and buying a $50 million gold mine really just doesn't make any difference for them. But going out and buying a $5 billion mid-tier miner might. And so this idea that you're looking at a period where there could be some, or certainly in the past, and there could well be some corporate action within this sector, is well worth thinking about in terms of what stocks do you look at from that? And so a mid-cap sort of gold tilt we think could be is worth thinking about within that framework. Then you get into some of the small cap ones. Now, we don't have tilts on these for a couple of different reasons. One is, if you're talking about small cap producers, typically one mine only, or maybe a couple of quite small mines, but you are particularly exposed to issues around that, operational issues around that. And so if you want to buy these on with a view that you like that area of the gold mining sector, yes, I think the small cap miners are going to benefit the most for sort of larger sort of strategic reasons. You want to buy a whole bunch of these guys. You don't want to just be buying one or two, because you buy one and it has a problem. It's mines in a country where all of a sudden there's a coup and they lose the mine to whoever wins the revolution. And so there's those types of issues that you just really want to be aware of in buying small cap miners. And then the next stage on is the explorers. And so they're the ones that have don't have the production. They're out, they've found something, they're trying to prove it up. They might be trying to turn it into an operating mine. Lots of different risks and very different risks around that. Again, if that's your area, from a macro perspective that you want to invest in, you want to be investing in a reasonable number of these, and really sort of focusing in on that idea that there's a lot of individual risk. You either need to do some deep research and be comfortable you've got the right gold stock within that, or just hold a lot so you're not sort of exposed to those individual risks, which is much less of an issue when you're buying the large cap mining stocks, because they do have a range of different mines and different geographies and all those types of things. So there's sort of your big picture ways of getting exposure to this. They do provide you very different exposures. The gold miners do tend to lag the gold price when you do see these sudden moves up in the gold price. And they will probably lag on the other way down when gold prices are falling as well. But within the gold miners, they'll be pricing particular amounts of, they won't be pricing the spot price, I guess is where I'm getting to for this. There's some sort of expectation from analysts about what the gold price is going to be priced into these gold prices. It won't be the spot price. It'll be some sort of, I've done a fair bit of work into looking at forecasts and stuff like this from analyst forecasts and sort of what flows into actual pricing. I think the sort of better sort of from a quant perspective, if you used some sort of trailing average of what the gold price has been over the last little while, it's actually pretty close to what forecasts end up being, and seems to be what gets priced in. So I can't remember the exact band within that, but let's say you were using an 18-month average of the gold price, and then comparing that to what forecasts were, you'll find that's pretty close to what forecasts are and what's being priced into gold stocks. So the longer the gold price stays at a higher level, you will start to see that gold price is reflected in gold mining stocks. So as you get sort of more stability in prices, the gold stocks will catch up in terms of that. But when you get sudden moves, if you're looking for those, getting exposure to those sudden moves, then you want exposure to that commodity in itself. As I spoke about before, the problem with gold is what's it tethered to. Yes, all these factors we spoke about, these sort of 15 factors about why, and all those 15 factors sort of moving in that same direction about, why people might want to hold gold and hold more gold. None of them tell you what the right level is. So, I can tell you about stocks, for example, and say, yes, there's this idea that we're buying AI stocks because they've got better growth than the rest of the market. And at worst, even if I can't put an exact on what the growth is, I can at least tell you, well, priced within the way they're priced at the moment, AI stocks are priced for sort of 10% plus per annum growth over a decade, more than the rest of the market. So you get a decade of 10% plus in AI, and that justifies the price premium you're paying for it. If you said, well, what's priced into $4,000 gold versus $4,500 gold versus $2,500 gold for the anti-dollar US trade? I don't know. For an inflationary trade? I don't know. For a safety trade? Who knows? The question is, if these things are moving in this direction and people want to be buying gold to be anti-US dollar, then the same logic works at $2,500 as what works at $4,500. If you're buying it because you think central banks are going to keep on buying, then the logic at $2,500 is the same as the logic at $4,500. If I think central banks are going to buy it, and that's why I'm buying it, then chase it higher. So is there something that would stop central banks from buying it? Look, it's a sentiment idea and an idea that I think these things move gradually in terms of the expectation. We've had a relatively sudden shift, I think, from central banks into wanting to own gold. I think a move backwards to not owning gold would be a much more gradual one. So from an investment perspective, knowing what you're buying within these sectors, why you're buying it, is important. And because if you're trying to get access to those short-term gains, then trying to get that access to the direct gold is what you want. If you're trying to get access to a longer-term rise in the gold price, then there's still value within gold stocks if that's your expectation, because they aren't pricing the spot price in. And if the spot price stays at 4,000 or 5,000 or let's say it trades between 4,500 and 5,000 for the next few years, then you're going to see more of a rise in stocks than what you're going to see in the gold price. And then finally, that whole idea that, well, should I be hedging in Aussie dollars or not hedging in Aussie dollars? I tend to like to think of a lot of these about as trying to price it as two different things. If you want both an Aussie dollar hedge and you want a gold price, then you can bundle it all into the one asset. That's great. I personally tend to try and separate the two, because sometimes I do want an Aussie dollar hedge, sometimes I don't. And having that within the one trade for me can sometimes be more problematic. But I can see the attraction for some people to say, no, I want that hedge back to Aussie dollars and pick up or lose whatever the expectation is on that. And so that's sort of this idea that it's a relative game between Aussie dollar and the rest of the world. So that's your they're your sort of big options. So I'll just sort of recap that, and then we might leave it at that for today. But the options we really have is, I'd say there's 6 ways you can get exposure to gold. 4 of them we have within Nucleus and within the direct indexing, which is the direct gold bullion, price in US dollars, direct gold hedged to Aussie dollars, the large cap mega miners, which are if you're expecting the gold price to stay high, they're not pricing 4,500. They'll gradually rise up if that price sort of stays for an extended period of time. They're probably going to be out buying those big guys. Maybe there'll be some mergers from the big ones, but they're actually more likely to be buying the mid-cap ones, and that's your other tilt you can get from us, your 4th tilt. You can get the mid-cap gold miners. Beyond that, when you're going to get into the small-cap producers or the small-cap explorers, the key one there is you either need to have your research done and know that you really know what you're buying and what the risks are within that, or buy quite a basket of them in order to try and get try and hedge out some of that operational risk that you're going to run within those. So that's your sort of four things behind that. And then I'd highlight again that there's sort of 7 reasons why you might be wanting to hold gold at the moment. All of them seem to be moving in the direction of gold, which is why we've seen the gold price high. The 7 are: it's an anti-US dollar, an inflationary hedge with a maybe, the safety trade and the geopolitics trade behind it, some sort of insurance hedge on broader societal breakdown, a greater full investment for investors, saying I'm trying to front run other investors. Same thing for central banks. I'm trying to front run central banks. And finally, the idea that, look, at some point, maybe we go back to some sort of gold standard or something like that. While I don't think that is very likely, it's far more likely under a Trump president than any other person with or any other recent political figure we've seen. Right, so with that, thanks for listening in. We're on every 12:30 Thursdays. Apologies for the 1 day delay on today. If you do have, if you do listen in, you can pop in any questions. We are on all the major podcast platforms. You can also get us on a bunch of different social medias. We would love if you could hit the like and subscribe button. And if you want to have a quick look at the types of portfolios we could get for you, there is a QR code on the screen now at the moment. Jump on and have a look, and we can see how you could fit gold within your portfolio, or you can see the types of stocks we're buying within ours. And yeah, thanks for everyone for listening, and we'll speak next week.